Tencent shares recently surged 10% on news of a secret artificial intelligence agent testing inside WeChat, yet the stock remains down over 20% year to date. The market is pricing this $500 billion tech giant like a slow-growing dinosaur, treating artificial intelligence development as a pure cost center rather than a cash engine. But the real data reveals a massive disconnection between public narrative and actual earnings power. While retail investors panic over regional headlines, a closer look at the underlying financial reports shows an incredibly strong capital generator trading at 46% below its fair value estimate. This is not an artificial intelligence laggard trying to catch up. It is the future artificial intelligence landlord of an entire digital economy.
Tencent operates as the absolute largest video game publisher globally, owning legendary high-grossing franchises like Honor of Kings and Peacekeeper Elite. Beyond gaming, it controls WeChat, China's ubiquitous super app with approximately 1.3 billion active users. WeChat integrates messaging, payments, short videos, mini programs, and enterprise collaboration into a single daily workflow. Gaming remains the primary profit engine, contributing roughly 60% of the firm's total operating income. Operating within the communication services sector, Tencent serves the entire digital consumer and enterprise market in China. This company matters right now because it is positioned to turn its massive user network into an unmatched ecosystem for consumer artificial intelligence. Financial analysts project a highly steady 10% 5-year revenue compounded annual growth rate for the business. Even more impressive is the expected 14% 5-year earnings per share compounded annual growth rate, which is being supercharged by significant margin expansion. Free cash flow continues its upward trajectory, backed by an exemplary capital allocation framework and robust operating cash generation. Value-added services, including gaming, are projected to expand at an 8% compounded annual rate. Meanwhile, the advertising segment is leading the charge with an expected 14% 5-year compounded annual growth rate. This rapid growth has surprised skeptical analysts who have consistently underestimated the long-term runway of WeChat's internal monetization levers like video accounts advertising. At the current market price of $55.30 per American depository receipt, Tencent is trading at a stunning price-to-fair value ratio of 0.54. Shares are priced at a conservative 15 times headline price to earnings for 26, and a mere 13 times when you strip out the substantial value of its external investment portfolio. This valuation stands well below its historical averages and fails to respect a business capable of sustained double-digit earnings appreciation. The market is discounting the stock as if it faces permanent stagnation, leaving an immense margin of safety. To justify this rock-bottom valuation, the business would need to stop growing entirely, making the stock look exceptionally cheap relative to its wide economic moat. The company's core profitability engine is executing a powerful shift toward higher efficiency. Analysts project Tencent's overall operating margin, excluding interest and non-operating gains, to ramp up to 43% by year 29, climbing from approximately 36% back in 24. This gross and operating expansion is structurally driven by high-margin segments, particularly video accounts advertising and expanding enterprise software monetization. Simultaneously, a reduction in App Store revenue-sharing deals is lifting structural margins across the digital services pipeline. While the business services and cloud units have historically held lower margins, the gaming and advertising segments continue to be the high-margin locomotives driving the company's superior returns on invested capital. Tencent is actively transitioning from an aggressive external venture investor into a highly disciplined internal compounder. Management is shifting away from low-hanging external deals and allocating capital aggressively into massive share buybacks, internal reinvestments, and artificial intelligence infrastructure. The company's unique approach involves deploying graphic processing units entirely for internal products and efficiency gains, rather than selling raw cloud compute like traditional hyperscalers. This fast follower strategy allows them to integrate their Hunyan 3 large language model directly into existing products where it creates immediate economic impact. This tactical evolution is far from an act of desperation. It is a logical, exemplary deployment of capital by a skilled leadership team. In the digital arena, Tencent faces fierce rivalries from prominent tech giants like Alibaba, NetEase, and Baidu. ByteDance also represents a key competitor, applying constant pressure on consumer screen time and domestic advertising budgets. Despite this competitive intensity, Tencent maintains a firm grasp on the third position in China's overall digital advertising market, with an 8% market share. NetEase competes directly in video games, yet Tencent's top hits maintain multi-decade longevity due to superior social integration. Tencent's massive competitive gap stems from WeChat's core network effect, which creates a seamless entry barrier that standalone ecosystems operated by Alibaba or Baidu simply cannot replicate. The ultimate risk that could break this investment thesis lies within the unpredictable domestic regulatory landscape. Sudden gaming license suspensions, like those witnessed in 2018 and 2021, can instantly disrupt software release schedules and force expensive reallocations of corporate resources. Furthermore, regulatory shifts in the financial technology sector, such as forcing payment providers to park reserves in non-interest-bearing central bank accounts, can instantly compress unit economics. Investors also face structural execution risks due to the variable interest entity setup, where international shareholders hold equity in a Cayman Islands shell company rather than direct ownership of the domestic operating business. The core catalyst to drive shares significantly higher is the rapid monetization of internal artificial intelligence applications. Success over the next 1 to 2 years looks like a steady rollout of WeChat artificial intelligence agents that deepen user lock-in and trigger multiple new revenue pathways. This bull case includes premium subscription fees for advanced tiers, highly targeted conversational advertisements, and increased payment take rates flowing directly through WeChat Pay. If Tencent successfully scales these embedded features, its ad load, which currently sits below a conservative 5%, has an enormous runway to expand. Achieving these milestones would validate the analyst fair value estimate of $102 per share. Ultimately, Tencent is a wide moat, classic total return compounder disguised as an out-of-favor regional technology company. This investment is ideally suited for patient, long-term value investors who possess a high risk tolerance for regulatory noise, but want exposure to dominant tech infrastructure. At less than 16 times forward earnings, the risk-to-reward ratio is tilted heavily in favor of the investor, leaving plenty of room for operational error, while pricing in almost zero upside. Wall Street is treating artificial intelligence as a threat to this business, when the data shows it will actually become its greatest monetization engine. Buy the cash flow, ignore the skepticism, and let the network effect do the heavy lifting. That is all for today. If you found this data breakdown helpful, make sure to hit the like button and subscribe to the channel. Drop a comment below with your thoughts on this stock and let me know which company we should look at next. Thank you for watching and see you in the next video.